We're getting down to it in February, Dan. Monday the 27th, tomorrow's the 28th, and Audi 5000 for the month of February. This is Market Call, 1 p.m. on the East Coast. I am Guy Adami. Dan Nathan coming to us from parts unknown in just a few minutes. Carter Worth of Worth Charting. And let me tell you something, folks. He looks exceptionally good today. Slicked, if I may say. Today's episode of Market Call brought to you by FactSet, financial data and analytics powered by tomorrow. I was about to say something else. Big week for the market. Big week for a lot of NHL franchises. You've seen a lot of teams make moves. Obviously, Timo Meier going to the Devils is huge. Kid is a stud. That really solidifies their, I would say, their run to the Stanley Cup. But the Rangers are going to get Patrick Kane this week, Dan, and that's also exciting. How are you?
That's super exciting. Yeah, just so you guys know, the viewers, loyal viewers of Market Call, we're trying to get Guy a sports talk radio show. So sooner or later that might happen. He'd be fantastic at it. Let's talk about this market, man. It's interesting that there's different market periods that are defined by opening gaps, right? Like where you have a move from one day to the next where there's like a 1% plus or something like that. Obviously, that would imply some sort of volatility that just persists on the headlines that you see on a day-to-day basis, that sort of thing. A lot of markets, that we've been in, really a lot of the movement comes like throughout the day, right? Like, you'll have these sorts of movements. So I always find days where you see like a 1% gap in an index really interesting because it has to assume that there's some piece of news that's driving that. Today, there was none, Guy. I mean, when you look at this, look at the S&P, none that I saw, for instance. We had this is a 2-day chart here. We had that gap move higher, about 1% or so. It's given back about half of that since then. I find those days really interesting because they provide the opportunity that either they come in, they fill in that gap, they hold, and then they get back going, or they accelerate the opposite way, right? You know what I mean? To the downside in this case or something like that. So I always find gap days in the markets really interesting.
Yeah, definitely days you need to bookmark, as you said. And, I'm not trying to link causality here, but everybody tries to find a reason for things happening. So I'll take a stab at it. I think the softer than expected durable goods number, I think probably got people excited, as counterintuitive as that sounds, saying, You know what, things are ratcheting down in a meaningful way. It all comes back to the Fed and what are they going to do. So I think that was part of it, and we'll see. But the reversal, at least we saw an hour and a half or so ago, we almost got down to unchanged. We bounced a little bit, but you're right in your assertion. These are days you want to look at. I'll say this, and not that I'm looking to play stock market, but we talked about Facebook a few weeks ago when they reported earnings. You had that gap open around 183. The stock spent a few days between sort of 183 and 190 on huge volume. And that gap that was created to the upside, we now have a little bit of a gap to the downside. Look at Facebook today, trading about 170, lower on the day, actually, which is interesting. So just things to keep in mind. These gaps sometimes rectify themselves in ways that are not all that bullish for the market, at least gaps to the upside. So we'll see how the rest of the day shakes out.
Yeah, and single names, when you get those sorts of gaps on some sort of event, I mean, like at the end of the day, it's a kind of a mispricing, right, of expectations. And therefore, at some point, if all the shorts cover to the upside, if all the exuberant, the FOMO folks, chase to the upside, well, sooner or later, you get to a period where there's less news, right? And therefore, it just kind of fills in that gap. And I think on the market, from the market standpoint, I think it's kind of interesting, right? Because the S&P is a group of 500 stocks, and all the components, have a specific weighting in there, and they kind of driving a lot of the action. And so for me, when you see the sort of situation after a few weeks down in the S&P 500, at one point last week, probably giving back half the gains for the year. I think we're up nearly 10% or so. When you start getting a gap open, it kind of tells you that people are a little nervous. You look at that chart here, we're kind of straddling that 200-day moving average. Carter last week very well detailed that uptrend that's been in place from the October lows, and that's the sort of battleground. The NASDAQ, not too different of a story here. The S&P is still above that 200-day. The NASDAQ is right at it. And I'll just mention this. I mean, that uptrend in the NASDAQ, Guy, is year to date. Okay. So the NASDAQ in January was very close to its October lows. It was being weighed on by maybe it's tax loss selling and some of the, a lot of these big tech names that make up a disproportionate amount of the weight of the NASDAQ 100. But this thing's come off. I think this is at a very crucial juncture. And I'll just mention this, the sixth largest holding, which is Tesla, about 4%, has this really big investor day on Wednesday. So it'll be really interesting from a sentiment standpoint. Investors are kind of holding this thing up. It's up about 100% from its lows in January. And if nothing comes out there, man, I mean, that could lead to the downside, I think, a little bit. I'm obviously positioned that way. I'm long the TLSQ, and I'm also long calls in that thing, looking out a few weeks here. So I really think that Tesla is going to kind of retrace some of that move. But again, that was what makes a market, guy.
Yeah. So we'll go backwards real quick. In terms of Tesla, it did, again, I was one of the people that thought you should fade it into earnings. I think the stock was trading either side of 150 into earnings. That proved to be incorrect. And now here we are. But again, you got to trade with what you see in front of you. And that comes down to, where did it go? Well, it got right up to the 200-day moving average. We thought 225 was a logical area. Carter talked about that as well. So what is a significant pullback look like, or what is sort of a very orderly pullback look like? Probably about a 50% retracement of the move you just talked about. So back down to about 165. And I think you're right. I think Tesla is a big market sentiment stock without question. It's joined the ranks of Apple and Amazon, and to a lesser degree, Microsoft, in terms of how people view the broader market. And in terms of the broader market, that go back to that NASDAQ chart real quick, or the S&P chart's even better. We got down to 39.40 or so on Friday. That was the 200-day moving average. It made sense that we bounced. We did bounce, and now we're bouncing a little today. But how long does the bounce hold on, and how strong is it going to be over the next couple of days? If we give it up entirely today, I think it stands to reason that uptrend line that you drew is probably going to be violated to the downside.
Yeah. And I mean, listen, this is also a lot about rates here, right? So we're going to have Fed speak all week here. Okay. We got some of your faves, Kashkari speaking a couple times, Lori Logan at the end of the week. I mean, there's a lot of Fed speak. So it's interesting that you started out by saying, maybe because of slightly weaker than expected durable good numbers, suggesting that maybe CapEx is sort of fading a little bit. And that would be kind of, a sign of a kind of weakening economy, which would you see an acceleration of maybe some job cuts and, the like. And these are some of the things that the Fed would like to see the economy cooling a little bit. But the fact that the market gaps up 1% on that is just crazy to me. But also what's going on here is, normally if you had a weakening economy, you would have a 10-year yield, guy, that would be reflective of that. It wouldn't be looking at pressing multi-month the highs, you know what I mean? Yeah. So here we are, we're making this little flag after this rally, and you look and see where the 10-year got some support at its 200-day moving average. And I'm just hard-pressed to think that if the 10-year gets above 4% for the first time since early November, that S&P, like S&P valuations are going to be under pressure here, and specifically names like Tesla.
When you see 10-year yields continue to move higher, I mean, you're talking about almost a 50 basis point move. It's actually probably now north of 50 basis point move to the upside from that low we saw month or so ago in 10-year yields. Typically, to your point, that would be because the economy seemingly is doing better. Yet we're seeing interest rates go higher with softening data. It's somewhat counterintuitive, but it speaks to the problem that the Federal Reserve has. I mean, clearly inflation is still a problem, and that 2s, 10s, which we'll talk about, that's getting up almost around 90 basis points or so. Where I stand. I think we're going to 1%. I think just in terms of the media attention, a 1% inversion will gain. That'll capture a lot of people's imagination, I'm sure. Again, I've thought it was more in the form of sort of 3.5%, 4.5%, or maybe 3.75%, 4.75%. Maybe it's going to be 4%, 5%. I don't think the levels necessarily matter, although I will say this. The higher the 10-year goes, the more bearish I think almost by definition you have to be for the broader market, because, again, it's not going higher because the economy is doing better or individual companies doing better. It's going higher because inflation is still a problem.
No doubt about it. All right, let's just throw up the 210 spread here. And to your point, guy, it's very near wides at 88 basis points. We're going to talk a little bit more about this on our Friday on the Tape podcast and kind of what some of the implications. We've got a great viewer question on that, so stick around. And I just think, to your point, we'll just highlight the fact that when you get to 1%, which is something that we have seen very infrequently in the history of this yield spread, who knows what happens? I mean, that's the point. Why do we kind of focus on some of these nice big round numbers numbers per se, but sometimes, I mean, listen, more and more algos are in control of the direction of the markets after like headlines come out or after certain levels get reached, and less qualitative judgments about these sorts of things, Guy.
I agree with that. And, it's going to capture the attention, I'm sure, of every economist has ever been he or her, it's ever been on CNBC. They'll trot those people out to talk about the ramifications. There'll be people that say it doesn't matter. It's not as important. They're looking at other indicators. I know Doug Cass came on. He mentioned that the 6-month yield's the highest it's been, I want to say, in 15 or so years. That was problematic for him. So I guess it really comes down to this. Depending on your point of view or what you want the market to do, you could look at these things through any different lens. And I don't necessarily want the market to do anything. I'm just trying to read the tea leaves here. But what I'll tell you is, a continued inversion in this yield curve, which, by the way, got down to about 50 basis points or so, I think, at the end of last year, is right back down to the lows, going lower, which almost by definition is not bullish for the economy.
Yeah, fair enough. And it's interesting. So let's bring in Carter Braxton
Look at
Worth
his
here
hair today,
of Worth
by the way.
Charting. He looks great. He looks great.
Fresh, fresh out of the shower.
There you go, pal. I mean, early on a Monday late on a Monday for a shower, I guess.
Well,
but you're probably working out this
because it was starting so early. But anyway,
yeah, we got you, man. Well, listen, we want to hit gold, and you have some thoughts there. But at first, give us a sense, with this 10-year yield, that 4%, is that a psychologically important number? And especially when you're starting to consider the things that are moving the S&P around a little bit, just kind of thoughts if we are above 4% in the not so distant future. And let's just say the Fed continues with this hawkish sort of stance, at least from the commentary that they're giving here. It just feels like the higher for longer narrative is something that sooner or later is going to affect stocks, and maybe that's one of the reasons for the pullback we've had over the last few weeks. But they're still trying to hang on for dear life here.
For sure. I mean, I there's so many ways to interpret the price action in the bond and the reciprocal, the yield. But the thing that really full takeaway, that if you assess all the pieces, and right, wrong, or indifferent, is that I'm surprised how little has happened. Meaning, why isn't it 5%? Markets are ahead. We know this, right? These are just, remember, the Treasury, call it whatever, any government officials, these are just men and women who put the pants on and put their shirts on in the morning and get up out of the side of the bed. These are, just to be clear, right? And Guy, you'll love this. I mean, Paulson, this is a Goldman Sachs partner, had in the teeth of the 08 decline. This man got on the TV and said, we don't see any problems.
Mm-hmm.
The credit agencies who were paid to see problems, Moody's, they didn't see any problems. These guys could not find their glasses when we're going into it. They see the problems after. Well, the market's ahead of that. They're going to raise longer and longer, but the market's already, why are we not at 4.5, 4.7? We're sitting here just kind of grinding. It's basically the same level it's been 5 months ago, 6 months ago. I don't think we're taking off. I remain that ultimately we are watching the peak in rates.
All right, fair enough. All right, listen, Carter, talk to us a little bit, because again, we're going to hit the dollar in a minute, but what you're thinking about in gold. This has been something in GDX, the gold miners ETF. You want to look at a ratio versus the S&P, but this is something you've been active in over the last year. You see this, and I know Guy does too, and I can't wait to get his commentary on this too, but you guys see this as just a really great risk asset in the sort of macro environment that we've been in over the last couple of years, where the Fed has really dictated a lot of the action as it relates to rates and currencies and the like. And gold is really kind of been a star, I guess, over the last 6 months or so, but it definitely came in a little bit over the last few weeks. You want to think about it going the other way now.
Right. I mean, look, it's a great mystery. Half the world think gold goes up because of inflation. Half thinks it's deflation, right? You hear expressions. I've used it myself. Gold, rates to zero, gold to infinity. I mean, if rates go to zero, does gold go? But at the end of the day, it's still just a trading vehicle, and there are flows, and there's buyer, and there's sellers, and at some point we try to catch the direction right. Today's note to clients was just responding to or following up on a January 13th note, which was saying trim. We were going up and up and up and up, and the thought was, let's just pull this back a little bit. Now that we've sold off, I think you put back on that which was trimmed.
Mm-hmm. I agree with that. And if you look, Dan, you see an M&A in the space for the first time in a while. Yeah, on the margins, but I think you're going to see continued M&A in the space. I've mentioned it dozens of times on Fast Money on our shows that central banks continue to buy gold back in record amounts, and I think that will continue You see what's going on with the Bank of Japan. I'll use the word that they seem to be flailing a bit in terms of their currency and their bond market. Obviously, you see what's going on here. We talked about the 2s, 10s inversion. Carter's right. I think people are confused as to why gold works and why it doesn't work. One would think that gold's doing extraordinarily well in this environment, given the fact that inflation is a problem, but it's been somewhat muted because the Fed is trying to fight that inflation. I think gold is taking its cues from there. But I happen to think, again, and I've said this a number of times, the chart has pulled back. You're right. But I still think I'm very constructive here in the price of gold. It's one of those stories that nothing happens until it does. And then when it does, I think people are going to start to wake up. Commitment of traders, which is something commodity traders look at. There's really nobody long in the gold market in terms of hedge funds and SPX, which is actually very bullish for gold. So we'll see. The incremental buyer has been central banks. I think it's just a matter of time before the incremental buyer becomes hedge fund and SPX. And when they try to get in a meaningful way, gold's not nearly as big enough a market to take in the kind of inflows that I think it's going to see.
All right, so Carter, let's talk about the GDX versus the SPX. You want to look at the gold miners. You also want to look at the Bloomberg precious metals, which is, it looks like, 80% gold and about 20% or so silver. And then let's just finish off by looking at the GLD because, again, that's one that I think a lot of our viewers look to trade here.
All right, so this is the relative strength line for gold miners as measured by the GDX versus all stocks as measured by the S&P 500. And you could say that looks like nothing. And to be fair, there's maybe nothing going on, but let's annotate it. This is what my eye sees. First iteration. Maybe go back and forth, take them off, put them back. Look at those ovals. Now look at the next iteration. This is a sequence. We bottomed, you get a big move, and then you check back. It's underway. It's very similar to checkbacks in 15 and 18. And I think this is about where you get that pivot and you start to go again. So we like this. I think it's a great pair.
In layman's terms, Carter, what is the one that accelerates to the upside? So what happens under this circumstance? Obviously, I think you think GDX is going higher, but does it necessarily mean this SPX is going to move as well?
Well, you have to get something, right? And guys making the point that if you're going to get this line, which is going down, which means gold miners are underperforming the stock market, gold mining stocks, underperforming stocks generally. If the black line goes up, it can only be one of three ways. It means that the S&P is dead flat and gold mining stocks are doing very well, right? Or of course, you can have a little bit of both, right? But let's do the reciprocal is gold is dead flat and S&P collapses, right? Or you get a little bit of both, which is S&P kind of coming down, gold miners kind of coming up. My thinking is it can be any of those scenarios. I don't think you're ever going to get anything dead flat. That's not how markets work. So two of those three scenarios are kind of unlikely. I just think that you play this as a pair, and while pairs have, let me just say, pure pairs are relatively safe when you're doing Coke, Pepsi, Walmart, Target, right? This is not really a pure pair. So you can get this wrong both sides. You can put this ratio trade on and you can get it really wrong. But I think you're covered by the fact that you've had such a give back in the ratio that now is about where you get the bounce.
All right, let's think about gold, the precious metal here a little bit, because you have this chart and that looks like a very well-defined 20-year uptrend, right? And you see that downtrend from the post-financial crisis highs a little bit. And again, it feels like we're kind of in the middle part of this pennant a little bit here, but you think that check back is here to be bought and maybe a retest of that downtrend is in play.
Yeah, one could say, come on, you stuck that green arrow in there. If you didn't have that green arrow, who says that's not a pair of two? Fair enough. But you have to make a conclusion at some point. But the point of annotating a chart, putting in lines, is to try to see levels, reference points that will help one make decisions, or to show it to others who might not have seen it, right? And so one, it's incontestable, it's a 20-year uptrend line. Now, this give back of the earlier this year, we didn't quite get down all the way to that well-defined uptrend line. We ricocheted, and we are kind of in the midpoint. To some extent, one could say it's a pair of twos. But you make your bets. And my bet is that ultimately, you look at the next iteration, it's the same chart, but that this is what's going on, right? That we're basically in the process of ultimately continuing higher. And there's something nice about this. Now, to be fair, you must know that this index, it changes the weightings. If silver has a big move, silver can get up to 25% or 27%, and gold comes down. But it's basically a 2/3, 1/3, 3/4, 1/4 kind of thing, which it should be, right? Because gold is a whole lot bigger and a whole lot more important. So.
Yeah, and it's interesting because silver really has gone nowhere now. You had a brief move down in silver to the upside, but it's given some of it back. But to Carter's point, you could get one of these moves in silver as well. But this bet that I know you're going to illustrate an options trade on, Dan, is really predicated on gold doing something. And I think we both think that's going to happen. And we can take a look at the GLD chart just to sort of round this entire thing out and look and see where we've been, where we are, and where we seemingly are going. And, we're back down to levels that were resistance back in the summer. Past resistance becomes support. I think we're finding it. There were some people I think thought we get down maybe to the moving average. I'm not certain that's going to be the case. And I think we hold here and bounce, Carter. I mean, that's the way I look at this chart.
No, I think that's right. And one thing to point out, the absolute level of anything is what it is. But of course, inflation is an important part of long-term investing. So just to put this in context, we're sitting here at $18.20 an ounce, whatever, it could be $18.50, $1,800. But right now, on an inflation-adjusted basis, gold is the same level as it was in December 1980. Now, just to put that in perspective, in December of 1980, gold was $455 an ounce. And here we are at $18.20 an ounce. But it's the same level if you strip out the ongoing effect of inflation. So the notion that somehow gold is expensive or gold's gone, so it's the same price it was 42 years ago, right? Yeah. And there's no great runaway. To put that in perspective, oil's the same thing. I mean, oil, so ironically, oil can't stay this high. We get into recession. Oil's $76 a barrel. It's the same level as it was in December of 84. It was $34 a barrel. Is oil really that rich? Is that high? No.
Yeah, well, it's interesting. I think of this as gold, and I go back and forth between your technical take, Guy's fundamental take, and it just kind of it aligns to me as a good trading vehicle, like we just kind of described here, and kind of given what I think might happen in the S&P over the next month and a half or so. I want to get some long exposure here, and I was looking at the options markets, looking out to April expiration today with the GLD, the ETF that tracks gold, was trading about 169. You could buy the April 170, 182 call spread, paying about $3 for that, buying one of the April 170 calls for about $3.50 to open, selling to open one of the April 182 calls at about 50 cents. So again, that costs you about $3 or a little less than 2% of the ETF price. I have profits up to $9 between 173 and 182 with a max gain of 9 above 182. And I've lost up to $3 between 170 and 173 with a max loss of 3 below 170. So this trade idea, again, it risks less than 2% of the ETF price. I have a break even up a little less than 2.5% of the ETF price, and I have a max gain of about 5.3% of the ETF if it's up near those February highs. So that was up around 182. That's why I chose that kind of 170, 182. So I'm risking 3 to possibly make 9 if the GLD is up nearly 8% in a little less than 2 months. So I really like the risk reward of this trade. I like the technical levels. I like the fact that what I think as far as economic data and where we see kind of just sentiment moving in and around risk assets that should be exposed to rates and inflation and the like. And again, when I'm doing long premium directional trades, I am basically using a 50% mental stop to the downside. So for instance, if this thing were to go nowhere or the GLD were to go lower, when those $3 in premium that I paid for this $12 wide call spread is about $1.50 or so, about 50% loss, I'm going to cut that because I just don't want to see that move to zero. And again, to the upside, I might look to take profits on half this position if it's a double at some point between now and April expiration. So that's how I'm going to trade these guys call here.
No, that's right. And just in terms of the math, if you get a double in something, if you take off half, you're in the rest of the trade for free. And to your point, I think when you look for trades like this, you're looking at least 2 to 1. In other words, you risk 1 to make 2. I mean, that's the low end of things, but a 3 to 1, the risk reward sets up really well, Dan. And I think you've given yourself enough time in terms of the April expiration to take into consideration a lot of things that we think are going to happen over the next few weeks. So this makes a lot of sense to me. I'm sure Carter's aligned with it as well.
Yeah, Carter, real quickly, do you think that sort of move, a little less than 8% between now, April 21st is the expiration for this trade. So here we are, we're almost at March 1st or so. Does that seem like a big move no, it doesn't. Okay, give us your take on this one real quickly.
It's so you adjust for beta for an individual equity needs news, but this is something that can come to life. Commodities have a way of doing that. It's a nothing move if things get going.
All right, fair enough. All right, listen, Carter Braxton Worth, we really appreciate you joining us here on our Monday edition of Market Call. I know you're going to be back with us on Wednesday.
Yep.
You're going to be spending a bit more time with us there. So hopefully, maybe you guys tweet some stuff at us or email us, contact at Risk Reversal, and maybe Carter will do some, he'll take some requests on Wednesday. I don't know. We have some time here. So thank you so much, Carter. We appreciate it.
All right, man. Bye.
Carter's the man.
Guy,
his hair looks great.
You love it. You love it. You love it when his technical take lines up with your fundamental take on the GLD. I mean, that was a great question on the ratio, the GDX versus the SPX, because sometimes I think a lot of institutional, like people, Carter talks to some of the biggest fund managers out there, right? And they like ratio charts. That makes a lot of sense. I know that a lot of retail investors or traders, they're thinking about things in absolute terms, but I think it's another great way to actually help you work yourself into a trade idea or an investment, because the way he spec'd it out makes perfect sense. I mean, listen, there's a scenario where the S&P takes a dump and the GDX goes sideways. That ratio works, right? There's a way where the GDX takes off, the S&P goes where? That ratio works, and it can work small degrees. I guess the one thing it does take away is the likelihood that the S&P rips and the GDX gets killed. That's not a great outcome. That's
probably not. But I mean, in terms of what we think is going to happen, it all sort of lines up. And I asked the question and I knew Carter was obviously equipped to answer, just to point out to people, what you're rooting for, what you're looking to happen under those circumstances. And I think he's right. I mean, very rarely do things go nowhere. So you basically eliminate one scenario. And the scenario that I think is going to happen is, the S&P backs up from here and GDX probably has a meaningful move higher on the back of the underlying commodity. By the way, Carter said something before we look at the dollar chart. Throw up that nat gas chart, because he said commodities have a way of moving. Nothing happens until it does. And listen, without question, we were early and early in our business is wrong. But look at the move in nat gas over the last week or so. That's exactly what he's talking about. I think he thought it was going to happen a little sooner that it's done, but I don't think this is over by any stretch of the imagination. So you look at this nat gas chart and you see how quickly things can reverse. That brings me back to GDX and gold. Again, I'm not suggesting they're at all related. I'm just pointing out how quickly things can turn in the commodities world.
Yeah, that thing got really ugly, man. And so that's been a pretty fierce rally over the last few trading days. Let's look at crude really quickly again, because this is one where, we do have a dollar that's kind of moved a bit higher over the last, few weeks or so. When you look at crude, we've been talking about this thing. I mean, it really is, it just doesn't act particularly well. And again, I think some of the headlines out there from a geopolitical standpoint should be supportive of it, especially this whole COVID, China reopening trade and all that sort of stuff doesn't act well here. And I just think a breakout one way or the other, or breakdown might be really interesting, might be really telling for the commodity complex guy, because it really would be putting a bit of a bookend to this kind of 2-year period where crude oil has been one of the most, talked about risk assets on the planet, and not just among stock market, monkeys like you and me, but it's been really an important driver for a lot of price action in lots of different assets.
People will look at this and say, we're building a base, we're sort of going sideways over the last few months or so, getting ready for the next leg higher. And a lot of other people say you have a sloping moving average down, can't get out of its own way. A lot of good news, commodity goes nowhere, probably going to take the next leg lower. I can see both sides of that equation. I'm obviously more in the bull camp. A lot of people over the weekend, I read some people on CNBC today talking about the potential for crude again to get back on its horse to the upside. I don't know what the event will be to drive it there, but I know there are a lot of people still talking about supply-demand imbalances, and it still exists. Obviously, we've basically dwindled our SPR down to virtually nothing. At some point, that's going to have to find its way back to being refilled. We'll see what that does to the price, if anything. So there are a lot of things to be negative about. There are a lot of things to be bullish about, and the underlying commodity goes nowhere. But I'll say this quickly. The stocks continue to sort of hang in there. I think I saw a Shell upgrade earlier today. Valero's having a decent day. So the underlying equities that are linked to the commodity are still hanging in there. They're still holding their own, Dan.
Yep. Well, you've had a good call on that. And again, you've been a reload buyer on checkbacks in the XLE and the OIH. And I think that has made sense. I do worry that it's particularly crowded, and B, we start to see, the contribution to S&P earnings drop off. Our main man, John Butters, who runs the earnings insight blog over there at FactSet, has been tracking this in late Q2, Q3 earnings, for the S&P earnings for energy sector is going to go negative year over year. So, as far as growth is concerned. All right. Right before we get out of here tomorrow, before the opening guy is Target. And we talked about this a little bit on our On the Tape podcast that drops this afternoon with Liz Young of SoFi here. But let's just look at this. Let's look at the charts, because we were talking about the fundamentals a little bit on the tape. That's one of the ways we like to differentiate our programming people. This is meant to be very heavy graphic here. The implied move, this is a 1-day move, guy, about 8% or about $14 in either direction. And if you look at this thing, this is a brilliant chart. Okay. Look at that March low. Okay. That we had. Okay. That was a disappointing kind of quarter. The market was selling off a little quickly. It got back on its horse, made new 52-week highs. And then we had that May drawdown. And that was a huge gap. It was like a 25% gap or something. We were talking about inventories and a whole host of issues there. But look at that. It's really caught at resistance right around that $180 level, and then it's found support in that kind of 140 level. You see the 50-day moving average. It's about to cross above the 200-day, which has been shifting lower. Kind of an interesting setup. At some point, this is going to have an explosive breakout, but man, oh man, it really feels like it wants to go back and retest that support down there in 140-ish.
People are going to look at this, and you can hear it. I can almost see and hear the commentary about golden crosses and the 50 crossing the 200-day and how bullish that is, and how Brian Cornell's a genius and Target is cheap compared to Walmart. And all those things are probably true. The reality is, though, they've really failed a couple times now over the last year or so in terms of inventory, and their product mix doesn't really line up in the current environment that we find ourselves in, which is the main reason they trade at a discount to Walmart. So I'm here. This is one of those things where I think you sort of bring your popcorn. If you're bullish, what you're hoping for, I think, is the stock to flush and to retest those support levels, maybe on a day where we trade 4 or 5 times normal volume. And then maybe you'll have alongside trading opportunity. And if you're bearish, maybe you're hoping that they surprise people and we gap up to the upper end of that range and fail sort of at the 180 level, which we have a number of times. But right here, honestly, I think it's a coin flip. And I'm not trying to sort of duck. It just, that's what it feels like to me.
I don't disagree with you. And when you think about an 8% implied move in either direction, just using options to kind of express that view, it's just going to be a hard way to do it. So I'd almost rather wait and kind of see, because to your point with the thing at one, at the levels that it's trading at right now, it would have to be a huge beat and raise for it to blow out above that 180 level, guy. And I'm not sure, based on what we heard from Walmart last week and Home Depot in general, just about the consumer, that's in it right here. And I would also say that if it were to kind of miss and guide lower and it's not that bad and it's kind of retesting that, like it's below 150, maybe you start nibbling at this thing, because maybe the valuation does become, again, like, listen, taking shots into earnings, they often end up being very binary sorts of situations. And to the point, with an 8% 1-day implied move, there's not too many ways to express this where you can't get hurt. You can even get the direction right and you can lose money in the options market. One last thing, guy, before we get out of here, Neil Griffin, and maybe you want to put this up, Jacob, if you can. GLD only has a beta of 0.35. People want to deploy tail risk strategies after the tail risk occurs. Just ask Meb Faber. So I don't know what that means about asking Meb Faber. I know he's got a podcast, and I think he's a pretty smart guy here. I just say this about when you have a beta that low relative to the S&P 500, and we talked about the potential for an 8% move in little less than 2 months, the options in GLD are actually suggesting that they're cheap. I just told you, between now and April expiration, like, I can buy the at the money call, the 170 strike, for a little more than 2% of the ETF price. And think about that on single names. So if you ever were to get a big macro move that confirms the idea that gold should take off, that's a really cheap way to do it. That's just one way that I'm thinking about it. And also, if I'm going to use a mental stop of about $1.50, I'm risking about 1%. Okay. So like, think about that, to have that sort of exposure. So I like the risk reward there, but that's a really great point, Neil. And I appreciate you putting it out there.
Yeah. Well, maybe we should have Meb Faber on the On the Tape podcast. And,
Yes, we should.
We'll extend an invitation. Love your backdrop. Love Carter Braxton Worth. I love the audience. And again, check out the podcast that drops. I don't know if it dropped yet or will drop in the next hour or so, that we did with EY from SoFi earlier today.
Yep.
It's dropped. I'm seeing that. Jacob said you can catch that, Dan, at your favorite podcast store or wherever you find your favorite podcast. Apparently, there's a distinction. I want to thank FactSet, our sponsor, financial data and analytics that are powered by Tomorrow. They're also our data provider. We'll be back tomorrow, Tuesday, the last day of February. Strange things happen the end of the month, Dan. I'll see you later.
All right. See you later. Thanks.